Hi, welcome to the First Trust ROI podcast. I'm Ryan Isakainen, ETF strategist at First Trust. In today's episode, I'm joined by Jay Gragnani, senior market strategist at Nasdaq Dorsey Wright. For those that aren't familiar with Dorsey Wright, they've been around for decades providing invaluable research for financial professionals on things like point and figure charting, relative strength. They help identify areas of the market that, based on those signals, seem to be strong or seem to be weak. We've got a really interesting conversation ahead. Very much looking forward to it. Hope you enjoy it as well on this episode of the First Trust ROI podcast. All right, so Jay, we're here at the Nasdaq market site. We just had the pleasure in representing our firms for the opening bell to celebrate the 10th anniversary of the First Trust Dorsey Wright Focus 5 ETF, and that's ticker FV. Right. So it's always fun, but even more fun is the opportunity to get together and have a chat with you. We both have busy schedules, so thanks for coming on the podcast.
Yeah, I'm glad this worked out, and congratulations on pushing the button and ringing the actual bell to open the market. If you weren't here to do it, I don't know that the market would have opened.
You know, the interesting thing about it is it took me at least 3 or 4 pushes on the bell for it to work, and I was thinking we wouldn't have a market trading today, but fortunately, you know, there must be some AI in the background that pushed it for me.
That's good.
Because apparently I'm cold-blooded or something. It just didn't work.
But you did it. You got it done.
But we did it,
here we are.
And it was such a great experience. Okay, so you've been at Dorsey Wright for quite some time. My first interaction with Dorsey Wright was pretty early in my career. It was just after the dot-com bubble burst, and I came across some financial advisors who were just very, very into point and figure analysis and the research that Dorsey Wright was producing at the time. And as I got more familiar with some of the people that really tracked and followed what Dorsey Wright said, I realized that there is a group of people that are just really, I don't know if loyal is the right word, but very much committed to the benefits of that research. And it's been true for the last couple decades that I've seen that as well. So that being said, there are still, I'm sure, a lot of people listening to the podcast now who are scratching their head and saying, you know, who is Dorsey Wright and what exactly are you talking about? So
why are we here?
why are we here? So maybe broadly, tell our podcast listeners who Dorsey Wright is and, more importantly, kind of what you do.
Sure. So Dorsey Wright as a company was started and founded back in 1987 in Richmond, Virginia, which is where I was born and raised. And it was started at Tom Dorsey, Watson Wright. They were financial advisors, stockbrokers in the business. Tom actually had the opportunity to run an option strategy department at Wheat First Securities, which was a regional broker-dealer that's now part of Wells Fargo Advisors. But in 1987, he started Dorsey Wright & Associates really as an outsourced option strategy department for Wall Street.
Interesting.
And what he utilized after the crash of 1987 happened in October, he brought to the forefront the methodology that he used to develop his option strategies on, and that was the point and figure method of technical analysis. And today, we continue to utilize point and figure technical analysis within our global research platform. Now, that research platform is very comprehensive, focusing on technical analysis. So part of that is we put out about a 15-page research report every single day with content in that research report, all based on and primarily utilizing technical analysis. We also have individual stock screeners within the system. We have ETF screeners, mutual fund screeners, rankings on all stocks, ETFs, mutual funds, as well as ETF models. So it's a comprehensive research platform that financial advisors can utilize to help build portfolios and manage their client assets. And so that's kind of where it all started, is from that research platform. And outside of that, or on top of that, we have a traditional separately managed account business where we're an asset manager that if you want to outsource, and we can certainly manage and run strategies. And then we also have a sub-advising / indexing business. Okay. And that's where we partner with you on a number of different strategies. Right. But that's kind of broad brush, kind of what our business looks like today. We serve thousands of financial advisors all across the country, but we track and rank and evaluate stocks, ETFs, mutual funds on a technical basis. So for instance, if you're looking at a stock and you're wondering, geez, is this a good time to buy the stock, you can log into our system and see 0 to 5, very simple technical attribute reading, 5 being the strongest. And so I say that when is the time to buy the stock. We're looking at technical analysis, as I've mentioned, but that's one form of analysis, right? Fundamental analysis is the other side of the equation that help investors answer the question of what companies do we want to own?
So that's a good segue into one of the questions I wanted to ask you is, how do most subscribers or users of your research combine fundamental and technical analysis? Are there people that just use the technical part, and does it work better if you combine the two?
Sure. So yes, there certainly are people that use 100% technical analysis. There's some people that use 100% fundamental analysis. But what we see more often than not is advisors that are utilizing our research platform are doing it in conjunction with some type of fundamental analysis.
Okay.
Whether that be working off of a firm's recommended list of stocks, that their in-house analysts are saying, these are the companies that we like, their balance sheets are strong, whatever metrics that they're looking at. So we think these are strong companies. Now an advisor can take that list, plug it into our system, and he can see out of those companies, which are also strong stocks from a technical or a relative strength basis. So it's typically
kind of layers there. That's layers of the analysis that can take
Exactly,
place.
exactly. It's typically marrying those two things together that we see big usage on the research platform.
So you mentioned that it's the research that Dorsey Wright is doing is a form of technical analysis. It's a bit different from what you sometimes come across with other forms of technical analysis. So how are they different? How are they similar to someone who's got a line chart and they're drawing support lines and resistance lines? How does it differ?
Yeah, it's certainly a form. I mean, technical analysis is a very broad,
right?
And point and figure is very specific to a form of technical analysis. Very simply, if you've never looked at a point and figure chart, it consists of X's and O's, where X's represent the price of a stock is rising, and O's represent the price of a stock is falling. But it's a simple form of technical analysis that we didn't develop by any means. It goes back to the late 1800s in terms of its origination, but it's nothing more than a logical, organized way to uncover the imbalances between supply and demand in the marketplace. And ultimately, that's what it comes down to.
Yeah, I'm glad you brought that up, because that's another question that I've heard many times asked about technical analysis in general, point and figure charting as well, and that is, why does it work? Like, what's the philosophy behind why do these resistance levels and support levels and all of these different chart patterns? What's the underlying reason that some of that works? And is it just supply and demand?
Supply and demand. You think about, I mean, whether it's baseball bats, soccer cleats for your kids, steaks at dinner, cars. If there's more buyers out there than there are sellers for those goods, what happens to the price? They go up. There's more sellers than buyers, what happens to the price? They come down. Well, it's the same on Wall Street in the stock market. If there's more buyers for Apple stock than there are sellers, then what happens to that price? It has to go up, right? And so what technical analysis is doing and what point and figure is doing is helping us understand which stocks are being controlled by demand and moving higher, and which stocks are being controlled by supply and moving lower. So that point and figure is just our lens, our view into what the market believes the price of the stock is.
And there's a lot that's actually captured in the price.
Yeah.
There's a lot of the underlying fundamental analysis. There's a lot of some of the sentiment surrounding stocks. All of that is kind of wrapped up into the price, isn't it?
Absolutely. If you take a big funnel and all of the information that comes into the stock market, the traders, the investors, whether it's institutional or individual, at the end of the day, the price comes out of the bottom of that funnel, taking into account all of that information out there as investors are casting their votes, essentially, in terms of, do they believe the stock is going to go up or go down, right? And so that price, there's a lot of information in that price. And so when we're evaluating the price of a security and looking at those trends over time, what we're doing is we're simply listening to the market and reacting to what the market is telling us, as opposed to trying to tell the market what we think it should be doing.
Right. Okay, so one of the things that Dorsey Wright is well known for is using relative strength as the sort of foundation for a lot of the recommendations and models. So I guess as a starting point, can you describe what that means? What's relative strength?
Yeah, I mean, the relative strength, momentum is another word that gets used interchangeably with relative strength, but it's a ranking system. It's a means of identifying leadership within the market. And when we think about relative strength, it gives us the ability to understand not necessarily what stocks are going up or down, but which areas of the market are likely to outperform. So in a rising market, you might have stocks generally are all moving higher, but inevitably you will have stock sectors, asset classes that are doing better and outperforming all of those others. Relative strength is really designed to identify those leadership trends in the market and capture those areas that are doing well, but also, and probably more importantly, help us understand which areas are not doing well. What areas do we want to avoid and or underweight within our portfolios?
So what sort of assets are you applying that relative strength research to?
In short, anything with a price.
Okay.
I mean, if it has a price that we can get daily or regular feeds on it,
sure.
We can use relative strength. More commonly, stocks, sectors, asset classes is what we're looking at applying relative strength to. But the reality is, we apply it to commodity prices as well. We apply it to cryptocurrency, Bitcoin, everything else. If it has a price that we can attach to it, then we can compare relative strength. And it's nothing more than comparing. Take a simple example of, do I want to own energy stocks or do I want to own the technology sector, right? That's kind of the basis for that question. And we can compare those two sectors utilizing ETFs more often than not. We can do indexes too, but we look at it through ETFs predominantly. We can identify, do we want to own technology? Is technology outperforming the energy sector on a relative strength basis? And very simply what we do is we take the price of one asset divided by the price of another, multiply that number by 100, and then plot that reading onto a point and figure chart. So when we're doing all of this relative strength analysis, the numbers aren't as important as how those numbers create the charts, how the charts look after those numbers are coming in. But it gives us, utilizing the lens of point and figure, it gives us a view, and an objective view in terms of answering that question. Well, if the chart's on a buy signal, it's clear technology is favored over energy, so I want to be over here.
So I think that's one of the key things that, as I listen to the people that follow your research often say, is that it's objective. And it's also pretty simple. It's, I think sometimes we think that you really have to have these complex algorithms that have all these different variables that you put in. And the problem with that is the more variables you have, the more potential you have for error with one of those variables throwing things off. And here's a digression, okay?
Okay.
Quick digression. I'm a huge college basketball fan.
Okay.
You're a VCU alum,
VCU
right?
alum.
And the way that the tournament, the people that are going to make March Madness, the teams that are going to make March Madness, is reliant on net scores now, right?
Yeah.
So they've got these net rankings. So I'm a Syracuse fan.
Okay.
Okay. Syracuse is somewhere around 80. Now, I'm not going to digress too much, but I think they should be a lot higher. But it's a very complex formula that's used to determine what that net ranking is.
Yeah.
By the way, how is VCU doing this year? Are they going to?
They're
I don't know if you've paid attention to the net
compete.
rankings.
I don't know their net ranking, but I have attended a couple VCU games this year, and they're going to compete. Yeah, we're up there on the A10 side, so tournament's coming up this week, I believe, here in March. So I think we'll be good, in a good place.
They, you know what? Come March, they have a tendency to be electric from time to time, like a really fun and interesting team to watch. So I haven't, to be honest, watched them much this year, but
they're still fun and exciting. I don't know if we're Final Four run like we did a few years back.
Yeah,
but it'll be fun.
But again, the reason for the digression is I like simple things that are easy to understand, and I think that's what relative strength and some of these other ways of looking at markets and measuring supply and demand. One of the benefits of that is it's easily understandable and relatable, and it's easy to explain to clients. I think that's one of the virtues that I see from that sort of research.
Yeah, and going back to that, the objectivity to it is important, because we have a team of research analysts that sit in Richmond, Virginia, that are supporting advisors, taking phone calls from advisors all day long. And no matter who picks up the phone to answer the question of, is Apple a strong stock or is Apple in a positive trend? You're going to get the exact same answer because it's clear. It's either in a positive trend or it's not. It's either on a buy signal or it's not. So it's very clear from that perspective.
So what's true of every sort of research, every way of picking stocks is there are certain times where they work better than others, and that's true of relative strength as well. So relative strength, when does it work best and when does it tend to struggle a little bit? And unfortunately, that's only known in hindsight, so I want to put that out there first. But when does it struggle? When does it do well?
Yeah, I mean, it does well in good trending markets where there's good sustainable trends. Where it doesn't work is when you have trendless or very choppy leadership changes. So, I use the example all the time in talking about just from the sector level. If you look back over the past 20 years, the differential between the best and worst performing sector in any given year is about 40 percentage points, just using the broad 11 groups, right? That's a massive opportunity to outperform by identifying leadership trends, sticking with those sectors, but also avoiding those weak areas of the market.
Sure.
So when you have good sustainable trends, relative strength can identify those. That's when you're going to have more excess return. The wider that spread gets, I said 40% on average, it can be more. The bigger that spread, typically those are the years where you're getting good sustainable trends. When those trends reverse, that's when you tend to see periods of underperformance. If a market goes from a growth-driven market to a value-driven market, we can identify that, but it's going to take some time for that transition to happen. And so, I think about, you mentioned college basketball. Talk about track and field for a second, a relay race. I ran a relay race when I was running track many moons ago, not on a Division I college level, but if you think about running a relay race, you take the baton, the first sprinter takes the baton, runs as fast as he can for 100 meters, 400 meters, whatever the distance is, let's say 100, runs as fast as he can for 100 meters and then has to pass the baton. So that runner has to slow down a little bit to make sure that pass happens, because if you drop the baton, you're out.
Right.
And then the next runner can take it and move on. That passing of the baton, that's those periods where you're going to see relative strength tend to struggle, is in that transition period. Because that old leadership has to underperform by definition to move out, and the new leadership has to take some time to get going. So those you mentioned and that's a great question, because it's all well and good to talk about when things are good and when it works, but it's also important to understand when it's not going to work as well, or it's working, it's doing what it's supposed to be doing, but it's just going through that transition.
Managing expectations, because as you said, that is by definition what has to happen. There has to be an underperformance in order for relative strength to change, if I understand it correctly.
Absolutely, yeah.
And so that's what you should expect. And between trends, you should have a level of underperformance, and then hopefully you identify a long-term trend that's sustainable over time, and you ride that for the next period of years.
Right.
Okay, so looking more broadly, right now we're recording this in early March, and things can change. So if you're viewing this podcast at some point after that, keep that in mind. But I want to get your take on what some of these relative strength signals are saying broadly within asset classes, or between asset classes, I should say. If you're looking at stocks, bonds, commodities, cash, what's relative strength saying to you now?
So if we're just from a very broad level, equities are still our top ranked asset class, specifically U.S. equities.
Okay.
International equities are ranked highly as well. And so a theme of that when we look across our equity or asset class rankings is certainly tilted more risk on, more growth oriented asset classes in general are where we're seeing the best relative strength. Conversely, the other side of the equation is the risk off, fixed income, cash, very low beta type of areas. Those are the areas that are weak right now.
Okay. What about so you mentioned that relative strength is really a form of momentum, right? So momentum is one of the factors that we infuse into a lot of our ETFs, and there's other factors like value and dividends and quality. How does can relative strength be applied to, or maybe other research applied to some of those factors and multi-factor strategies as well to kind of identify, well, which factors are strong?
Sure. Yeah, you can certainly look at comparing. If there, like I said, if there's a price, you can compare it. And so we do maintain and create performance or relative strength comparisons of all of the different investment factors out there in the marketplace.
Okay.
And you could do, there are some out there that do like factor rotation type of strategy.
Okay.
Do I want to be in momentum or quality or value? And there's a lot that do it based on economic cycles. When we look at it though, again, we're evaluating it based on performance. So there are time periods where momentum is not the best factor. There are time periods where momentum is the best factor. And so I think to your point of taking the approach of applying relative strength to other factors can be extremely complementary when constructing portfolios together. So,
okay, what about from a sector standpoint?
Yeah.
You know, as I mentioned at the outset of our discussion here, we were celebrating the success of a 10-year anniversary of one of our ETFs that uses a sector rotation strategy. So what is your research saying now about sectors? Is there anything that stands out?
Yeah, I mean, there's certainly some sustainable trends that we saw really take hold at the beginning to mid 2023, and that was a return to growth, a return to sectors like technology, semiconductors specifically has been incredibly strong. Consumer discretionary stocks have despite what some might have expected, have done extremely well in the consumer discretionary sector. So it's kind of a similar theme to the asset class in that growth is showing good relative strength, and the more value-oriented areas are showing the weakness in the market. And that was very different than, say, 2021, 2022, where those were more commodity-related, value-driven markets, especially 2021. But again, that changed really in 2023, where growth returned back into favor. So if we look right now at where the strength is from a sector perspective, and you look at those rankings, you see sectors like technology, subsectors like semiconductors, internet, specifically up in the top of the ranks, consumer discretionary, where you're getting the commodity related stuff, value stuff down towards the bottom.
Right. Okay, so shifting gears a little bit, one of the things that Dorsey Wright has done, I think, really well through the years, at least from an outsider's perspective, is developing a group of people that are really keyed in on your research. And one of the ways that you have done that is, at least I think, through doing on-site meetings where you get together in person and you present all this research. Today, you know, a lot of firms do that through Zoom calls or through online things, but you're still doing them in person, and there must be a reason for that. So maybe I'm just kind of wondering your philosophy at Dorsey Wright. Why is it so important to get those people together to kind of go through all the nuts and the bolts of what your research provides?
Yeah, it's a good point, because to me there's nothing that technology can do to replace the human interaction. We can do Zooms, but by getting together in person, you're going to have a much deeper conversation. You're going to have attention. You don't have somebody looking down on their phone on a Zoom call or virtual call. And you're going to just develop a level of understanding within the methodology, whether it's we get a group together, you know, about once a year, and it's a deep dive on point and figure specifically. So we're diving deep into the methodology, how to use the tools on the site, but then we'll also host events around the country as well. I know you guys do a ton of events as well supporting education. We hosted one right here at the Nasdaq Market site for a group of advisors that got together in a room and just talked about how they're implementing the research, best practices on utilizing it, how they're prospecting with it, and explaining that to clients. And those types of interactions, those types of levels of engagements are just second to none.
Yeah, I think that's one area of commonality between what we do at First Trust, what Dorsey Wright does. You know, we see a lot of value in face-to-face discussions and helping people kind of understand what our philosophies are, what we're trying to do in certain strategies. So I've appreciated that about Dorsey Wright over the years. Okay, so when was Dorsey Wright acquired by Nasdaq? How long ago was that?
That was January of 2015. So little over 9 years ago.
9 years ago.
Yeah.
Has that changed any of the research that you're providing? How has that changed things in the period since?
Yeah, I mean, so the Dorsey Wright business sits inside of the global index business within Nasdaq. And so there was, in the very early days, a lot of synergies because we had an indexing business as well. So there was a ton of synergies within that indexing business that we fit right in. So we're part of that business, which is part of a broader organization called Capital Access Platforms ultimately. But be that as it may, when in 2015 there was already a lot of synergies, and what Nasdaq has allowed us to do is come in and infuse a ton of technology to help bolster our research platform out there in the marketplace, and also support the financial advisors that we're serving as well. So you ask what's changed. Well, I wouldn't say a ton has changed from a research and methodology standpoint. We continue to focus on price. We continue to focus on the point and figure method of technical analysis. And at the end of the day, the price is going to be what is important, right? So
yeah. Okay, so you mentioned earlier that every day you put out a research report, and it's a big research. It's 15 pages. How do you come up with 15 pages worth of material every day?
Big images go in there. No, and so part of that. So again, we have a team of analysts that sit in Richmond that is what they do on a day-to-day basis is create content, and it's not the same specific area every day. So one day might be a certain sector ETF that's doing well. Part of that research report is individual stock ideas.
Okay.
So if you're ever looking for actionable stock ideas, the analyst team maintains a list of kind of actionable best in class ideas out there. So that's part of that. And then other days it's a lot of collaboration and talking. And so there's a meeting that happens every morning between the analyst team that talk and come up with ideas, and we also get a lot of feedback from advisors. Because that's one of the unique benefits of our research platform is access to all of those analysts.
Sure.
So you could pick up the phone and give them a call, and as their calls coming in, if we're hearing certain things out there in the market or certain common questions that come in, I mean, ultimately feedback from our clients is what drives a lot of what we do, whether it be from the research side, from the product development side. So we take into account a lot of research, but it's a team. It's a team that's putting out that research report. Sure.
It must be, because as someone who puts out research and publishes thing, that would be so daunting to put out that much on a daily basis. So hats off to the team at Dorsey Wright. Okay, so one of the ways that I like to kind of finish up these conversations is asking people what they're reading. Are there any books that you've read recently or on the horizon, or maybe you're in the middle of, that you would recommend? And by the way, we've got a fantastic list of books that my guests on the ROI podcast have provided so far.
Ooh, so no pressure, huh?
So no pressure, but no. What have you been reading lately?
So I have been a big fan of Malcolm Gladwell's books over the years. The Tipping Point is one. Blank is another one that I've read that have always been good. Michael Lewis. I mean, Michael Lewis does a great job.
Great storyteller
with putting content out. Those are books. The Michael Lewis books are ones. And I'll admit, I'm not the biggest reader in the world. I enjoy it when I can. I'm not the biggest reader in the world, but the Michael Lewis books are ones that I can get through, and because they're riveting, they're captivating. And so I love reading those. So what do I have on my book stand? So I've got about 6 books on my book stand right now.
Okay.
One of those books is Pappyland, which is about Pappyland. So that's taking us back to bourbon country.
Okay.
Looking at Pappy Van Winkle and the Van Winkle distillery. So I've started that one right now. So that's the
story of how that all came together. The business came together.
Yeah, the whole Van Winkle.
Prohibition in there anywhere?
I haven't made it that far.
Okay. Excellent. Okay.
So that's the one that I have open, and then I also have another one that I started that I recently received as a gift. Was I'm blanking on his name. Anthony Bourdain.
Oh yeah.
A book that
the
he,
chef.
the chef, and traveled around the world. I loved watching his shows.
Yeah, he was great.
But the book that came out was in partnership with one of his producers.
Okay.
So there's some of his writing in there, and then they were going to co-author it, and then some of fill in the blanks of what was going on. But it's one of those books that you can pick up, and it's not a continuous thing because all of the chapters are broken up by country and by experiences.
Oh, okay.
So if you're getting ready to go to Malaysia or somewhere, you can find his chapter on Malaysia and read all about it.
Yeah.
So that's been a good one. That's kind of off the business book topic and kind of a little bit more light reading.
I'm hearing you say it's kind of like a print version of some of the shows that he would do.
Yes.
Is that kind of?
Yeah. That's a good way to think about it.
Interesting. Well, I will have to add that to the book list when I'm, jetting around and walking through airports, listening to audiobooks and things. I'll tell you a secret.
Yeah.
Between us, I usually listen to books. I don't actually have time to read books either. So audiobooks are my way of actually consuming
that is a
books.
better thing that I need to do more.
Yeah.
I will tell you that the last audiobook I listened to, it's been years ago, is called Shantaram.
Okay.
And the cool thing about that, listening to that book, is all of the accents, because there's people from Australia and India, and when you're listening to a book like that on audio, you get all of those accents that you don't necessarily get from reading.
Sure.
So
yeah.
I'm a fan of audiobooks as well.
Okay.
Yeah.
Well, we'll add that one to Shantaram. I don't know. Do you know the author of that?
I don't know. It's been years since I looked at it. I'll have to follow up on it, but I bet you can find it. There's not many books out there called Shantaram.
No, I wouldn't think so. Okay, well, Jay, this has been fun. Thanks for coming on the First Trust ROI podcast. It's always great to connect with you, and maybe we can do it again sometime.
Sounds great. Appreciate you having us on. Always a good time connecting and getting together. And yeah, let's do it again.
I mean, we've been doing webcasts and things for how long? I mean,
so
we've known each other for a while.
So I remember the very first live event that I did with First Trust was back in 2007.
Wow.
In Kansas City, Missouri.
Yeah.
And so it was probably shortly thereafter. I would say probably 2008. That's when we launched the first ETF model.
Right.
Utilizing First Trust ETFs was back in 2008. So I'm going to put it back in 2008, 2009 timeframe is when we first did a webcast. That would be my guess.
Yeah.
Does that sound about right?
We're getting old is what that tells me.
I had more hair when we were doing that, that's for sure.
Yeah, I was probably 30 pounds lighter. But anyways, it's a pleasure. Thanks for coming on. Thanks to all of you for joining us on this episode of the First Trust ROI podcast. We'll see you next time.